Welcome to the Well-Rounded Retirement Podcast with John and Jim from CRIS Financial. In this podcast, we help you take a well-rounded approach to retirement planning so you can retire with complete certainty. If you're looking for proven and straightforward retirement advice, ranging from how to protect your assets to how to spend with confidence, this show is for you.
Hello and welcome to Well-Rounded Retirement with Jim Donewald and John Glowas from CRIS Financial. Gentlemen, how are you?
Good. How you
doing? We're doing good today, Eric.
Woohoo! All right, it is for all those.
It's Monday morning.
That's right. I was going to say for everybody listening, I don't know what day it is for you, but it is Monday morning for us, and getting together with these guys is fantastic. I enjoy it. They're like a double shot cup of coffee.
Very good espresso.
That's
Smooth,
right.
just a little bitter, maybe. No, I'm just kidding.
The old Americano.
That's right. All right, today I love the title of what you guys have sent me. They for the audience, they send me some notes just so I know what's going on today. And today we're talking about ruining your retirement.
Yeah.
Yeah. Well, it's always an exciting topic.
Just don't do anything. That would ruin it. What are some other ways that we can ruin our retirement, guys? I know that's what we're covering today, but where do we start?
Yeah, no, a lot of people come into our office and, they don't understand all the challenges maybe that are ahead of them. Taxes, I think, are going to be huge. We believe tax rates are going to go up dramatically, if not double, by 2026. That's such a big topic. We'll cover that at another time.
Okay.
Inflation, which we like to call the silent killer, just creeps up on everybody. And really what that is a decrease in, purchasing power as we, retire and get further and further in our retirement. And then there's the big one that we'd like to talk about today, and that's the long-term care plans, or should I say the lack of planning for people's health and what can happen. That's a huge one. Nobody's counting on it. I don't want it to happen to me. My clients don't want it to happen to them, but it's a reality. As a matter of fact, John and I just doing some work on this, and John, you want to tell them kind of what we found out?
Yeah, we, there's a lot of information that's out there regarding long-term care, and but there's a lot of things that we don't realize that each year over 700,000 people suffer a stroke in our country. Every 40 seconds, someone has a stroke in the U.S.
Jeez.
Parkinson's disease is nearly 1 million people will be living with Parkinson's disease by 2020. And then you have the big one, and that's Alzheimer's disease. That 1 in 10 people aged 65 and older will have some sort of Alzheimer's or dementia. And that's 33% of people aged 85 or older have Alzheimer's. But there's one that most people don't even think about, and that is osteoporosis. In the U.S., over 53 million people have osteoporosis or are at high risk and will need some sort of home health care, long-term care treatment at some point in time in their life.
Yeah, this happened actually to my own sweet mom at about, I don't know, she was about 85, 86, just, getting out of the bed one night, tripped on the sheets and broke her hip. Recovered from the hip surgery beautifully, and then it was kind of all downhill from there.
Yeah, they always say that once that starts, there is no direction other than downhill, and you see them go so quickly.
Guys, I don't know have you heard the statistic, and maybe I heard it from you guys originally, but 70% of all people will need long-term care.
Yeah, I've heard that, and that's these aren't scare tactics. These are just the real numbers. We get them all the time, and it's sad, and that could mean anything from a short stay to a long stay. That's what we don't know, but the odds are 70% of us are going to need some kind of nursing home care in our life, whether it's shorter term or long term.
How I picture this is, I'm married, and so we go out as couples every once in a while, and we'll go out with another couple and go out to dinner. Sitting down at that dinner, it's a 4-person table. There's 4 people at the table. 3 of us at that table will need long-term care at some time. That is because here's the thing. I'm a guy. I don't know if you've noticed that or not from my voice and such. But we kind of have this invincibility thing a lot of times. And so, I'm not going to need long-term care. That's not going to be me, right? Or I'm not going to be the one to get Alzheimer's, or I'm not going to be the one to get dementia. I'm not going to be the one that has the stroke. Because it's just not me. That's somebody else that happens to. But realistically, you're sitting at dinner with another couple. Out of the 4 of you, 3 of you are going to need long-term care. Pretty much 3. I mean, we're at 75% there. But man, that is a little scary. Even though we're not using scare tactics, those are just facts right now.
Well, like you said, and I know if we go out to dinner, and we have a couple of four. One of them's not going to be me, so that's all I count on.
Mm-hmm.
But we find that people, they're not against long-term care. They're just against paying for it. I mean, people think it's a good idea, and there's a lot of reasons we like to encourage to plan for it in some fashion. That doesn't mean maybe a traditional long-term care policy, but with those kind of statistics, we want to make sure that we are prepared if something happens.
Because it could actually, it can wipe out your entire life savings and everything that you've worked hard for your entire life. Because 10,000 baby boomers are turning 65 each and every day, and they usually have an average life expectancy to 84 to 86 years old. And so, Medicare does not pay for long-term care or home health care. You have to be broke in order to have Medicaid pay for your long-term care or your home health care in the event that you should need it.
Mm-hmm. And again, we're not trying scare tactics, but can I tell a short story here, guys?
Sure.
So my aunt and uncle lived up in Minnesota in a small town. My aunt developed Alzheimer's, and it was at home first. They were able to kind of manage it at home for a little while, and then it became clear that it was not going to be able to be managed at home because my uncle was a little older than she was, and I think at that point he was about 80 years old, and she was just slightly younger. And so she ended up having to go into a facility. The finances were kind of protected a little bit because, he had his pension and he had some retirement and he had some savings and things, and they were able to get it paid for through a couple different ways. So Medicaid will pay for things depending on the situation, but it's only after all the assets are basically gone. Well, my uncle went in, so about 5 years into her care at a very, in an expensive facility, all that was taken care of at that point. But my uncle went in to have a heart stent put in, and pretty routine procedure, but he died on the table. Then my aunt died 3 weeks later. But because he died first, the state came in and basically forced the sale. They had to take everything to auction. They had the homestead farm plot that they had from when my uncle was younger. He had the last 5 acres, and they had the outbuildings and barns and all sorts of stuff, all antique tools. All of it had to go to auction to pay for my aunt's care. If she had passed first, then it wouldn't have been that situation. But because it was, they lost the house, they lost everything. They lost all the property. The kids did. There was 5 kids. And that's tough to see.
Well, unfortunately, that happens a lot. That's why this is really big on our list, and every year it's moved higher and higher as we try to make everyone at least aware of it. And you think about what you just said there, the strain that's on the Medicare, Medicaid system with everybody, the baby boomers turning older, that's the problem. So what is happening now, which we like, is the federal government and some states are incentivizing us to plan ahead. And anytime, we do or take advantage of things the government recommends, they give us tax benefits, they give us little perks. And so it now may be better than ever to do some planning if you can. I mean, that's the whole idea. We want to encourage people to at least look at it. We've come a long way from the use it or lose it situation where you buy the long-term care, which I still think is a great product. You don't end up using it. You die in your sleep one night, which is, the way I'd like to go. And then you've lost all your premium. That's what people have an issue with. So we've got some alternatives these days.
Because we could do some sort of crisis planning, or we could do crisis prevention. And in most cases, it's better for us to do some sort of crisis prevention and go ahead and plan this out in the event that we had it. Eric, Ronald Reagan had Alzheimer's when he passed away, but he had Alzheimer's for 17 years. And that could be draining on someone's assets.
Yeah.
And especially the amount of not just the money that we're talking about, but the wear and tear on the family. Yes. And they'll take care of you as long as they can. And usually that begins to wear on their emotional and their physical, and the amount of care begins to deteriorate at that time.
Yeah.
As long as we're bringing it up, we had a client come in the office. He was about 75, and he already had Parkinson's disease, since we've mentioned that. And he had been turned down for long-term care elsewhere, and he was afraid he was going to waste our time. We said, come into the office, let's talk, let's see what we can do. We had this gentleman come in. His name was we'll call him Tom for our example here. He came in, and even though he had Parkinson's, so some of the other plans we're going to discuss here in a second wouldn't work for him, there's still ways of leveraging his funds to make it available to pay for this. So he was in the first part of Parkinson's, so he was still very functional, but he was already age 75. So at some point he felt, he wasn't going to be able to take care of himself. We figured about 5 to 7 years, we were able to take some of his CD money and we leveraged this into a policy that when he took income would actually double the income from it. It was an annuity long-term care product, and it worked out. The place he was looking, assisted living, was about $50,000 a year, and we took about $300,000, and we were able to provide that income starting in 5 years. So even though he had some health issues, there's still a way to leverage your money. When we started, John and I started doing this, I used to say, well, if you don't have long-term care, you're self-insuring. And what a mistake that was, because self-insuring is when you actually leverage something. What I was talking about really was self-funding. If you don't have any kind of coverage, $100,000 out of your pocket is $100,000. When you have self-insurance, $50,000 out of your pocket may make it $100,000. So the leveraging is so important, and if you don't need it, you don't lose it.
All right. So what are some of the other solutions that we can talk about today?
Well, asset-based long-term care is one of our
it's one of our strategies, and we call that lazy money. And basically, it's assets that we have sitting around the house that are in a CD maybe or a money market. And all we're basically doing is taking the assets from one pocket and putting it into another pocket and earmarking it for long-term care or home health care. Because believe it or not, most people would rather have their care in their home, not in a long-term care or nursing home facility. So home health care becomes more prevalent these days, and they seem to last a little bit longer by doing their home health care. And then their children can actually take care of them that way and get paid for the long-term care that they're receiving. Mm-hmm. So by leveraging your assets with an insurance-based product, what we call asset-based long-term care, you can leverage more of your assets that would provide you with that long-term care in the event that you needed it. And if you didn't need it, then the assets, of course, would go to their heirs, or you could do something else with it. If something else came up and you needed the assets, you're not really locked in, and that seems to be a direction that more people are willing to go that route rather than the traditional long-term care. Because if you don't use the traditional long-term care, you lose it.
Yeah. All right. Can you guys boil this down to some real life examples of you? So some stories that you can kind of weave in here so the audience can get a real understanding of kind of maybe a situation they might face and what a possible solution is, so we kind of have a little bit of light at the end of the tunnel.
Sure. Just like our first client we just talked about, he already had Parkinson's, but a lot of people are still relatively healthy. They don't have to be in perfect health, but they have to be relatively healthy. We had a gentleman, we'll call him Bob. He came in, he had diabetes, but it was controlled. So if everybody's got a little bit of high blood pressure, cholesterol. We see this constantly. That is not a deal breaker. And we were able to get him an asset-based long-term care policy. And what this consisted of in his particular case was really answering, 4 basic insurance questions. One of them being, are you currently residing in a nursing home? This guy was able to obviously answer those questions, and it worked out for him. And his family had made it very clear that, he did not want to move out of his house. They were all out of state. And like we talked before, it's not that your kids don't love you or they don't want to help you, but they'll take care of you until they can't. That's what we did with my own parents.
Yes.
We were 3 kids right next door. But at some point, it's just, we had 5 of us, 2 health caregivers and my 2 brother and sister. And you just can't keep up. At some point, it's too hard to do it. So this gentleman was able to do it. So even though he had controlled diabetes, he was still able to qualify for a long-term care benefit. And what this does, this allows us to take our current, he had put in approximately $300,000, and he was able to get $500,000 of long-term care coverage immediately. That's the big difference. We've converted that money from $300,000 to $500,000, tax-free, by the way, if he uses it for long-term care. And if something happens, his original $300,000 he put in will still be passed to his heirs. So we know something's going to happen. Either he's going to use it because he needs it, or he's going to pass away and leave it on there. So we know that where this money is going, regardless of what happens. So it makes people very comfortable.
Wow, that's great.
And I think a lot of these plans, people weren't aware of them. When I started doing this a long time ago, I did the original long-term care policies, and they're just as we talked about before. Nobody wants to think it's going to happen to them.
And they're medically underwritten, and most of the time, a lot of these, when you finally decide that, hey, look, I might need this, there's a possibility that I might need it. It's a little too late once we start to become a certain age that we can pass the medical history on the applications in order to qualify for traditional long-term care. So you got to have other solutions that are available in order to pay for long-term care, because like we said earlier, that Medicare is not going to pay for long-term care, and the only way that Medicaid will pay for it is you have to be broke.
Yes.
And so there is a statistic, though, that I'd like to say that Jim and I talk about at our seminars, that usually it's the male who goes into the nursing home first, and they drain the coverage. Like I said earlier, Ronald Reagan, 17 years, they drain their assets down to basically nothing, and then 63% of the spouses that survive the deceased spouse end up in poverty as a result of a long-term care event.
We mentioned this earlier. I said a broadcast for another day too. But you got to remember, as soon as your spouse dies, you're now single again. That's going to push them into a higher tax bracket, and that's another contributing factor that just kind of makes a already bad situation worse. When we have emotional problems, we don't want people to have financial problems on top of it. We want to be able to think straight and make smart decisions. So we really try to help them. So at least when something like that's happening, financially, they know where they're going.
Mm-hmm. Yeah, I mean, it is. It's kind of like adding insult to injury, literally. All of a sudden, you're single, but it's not the good kind of single, right? I mean, it was, when we were 20 and single, hey, that's great, but 65, 70, 75 and single, and then all of a sudden, Uncle Sam wants more of the money that you have less of. That's frustrating to me.
You lost your income, you lost your partner, maybe you lose your house now because you fall in a different category of, how to qualify and all that good stuff.
Yeah, absolutely. What other examples can we give the audience today?
Well, we got a client let's just call her Mary for this sake, and she's 63, and she's had her family's had a history of Alzheimer's disease, and so she wanted to make sure that she was covered in the event that she came down with Alzheimer's, since so many of her family members had it. So we took her account. She had $250,000 into an IRA. She also had $370,000 in a checking and a CD. So she's done very well saving her entire career. And she doesn't want to lose it to a long-term care event or a home health care event. And she has $300,000 in stocks and bonds. And so what we were able to do is we were able to take $150,000 of that money, and we put it into a fixed indexed annuity that specialized in long-term care events. And that money became tax-free, which was going to pay her $7,297 a month in tax-free benefits that she could use those assets either for home health care, assisted living, skilled care, a cash indemnity benefit, or return a premium after 10 years. And so it kind of fit with the needs that she needed, and she didn't have to use all of her assets. She basically just leveraged that smaller portion, and it provided her with all those benefits of the long-term care or the asset-based long-term care product.
Okay, so guys, I got to be honest, and I know that you started off this conversation talking about what long-term care insurance used to look like, the use it or lose it thing, and that really shied a lot of people away, or that was the frustrating part. But the other word that you're using a lot throughout this podcast is annuity. And I know that there's a lot of fear and trepidation or concern about annuities, but it sounds to me like there are annuities that are built very specifically for specific purposes.
That's correct. Yeah. There's basically three plans here that we kind of just demonstrated there, but there's and these are through the life insurance company. So depending upon health, once again, that's still the driver. Depending upon health, we can either do a long-term care annuity kind of life insurance. You can do a long-term just annuity. These are all geared for the long-term care. That's the strong point here. And then if your health is at such a case that you can't qualify at all for the insurance portion, we can still show you ways to leverage your money to help make some of these payments. The idea here is that realistically, if you've got money set aside, which a lot of our clients do, we always ask them, if you got sick tomorrow, where would you want your health care? They all say at home. And then we say, okay, what asset would you liquidate first? Well, maybe it's CDs, maybe even if it's an old annuity. They've come up with the Pension Protection Act. And this allows us another thing that a lot of people don't know is we can actually transfer that annuity for long-term care benefits and make it tax-free. Now, I'm not here to tell you, I'm not here to tell you, annuities are good or bad. We use them in our practice. We think there's a right place for them. As long as you understand them and how they work, I think they do wonders. I think for safety and security, they're very good. I know some people have trepidation about them, but they don't fully understand it, or they're getting advice that's 15 years old. I mean, you always have the choice of the stock market. They tell you it's always a good time to invest.
Yeah, I think that there's a lot of people that just don't understand the annuities, and a lot of times it's because the advisor doesn't share the information with them with how they can use that annuity to their benefit. And a lot of times the reason for that is that advisors, they get paid based on your assets and whether it goes up or it goes down. And if they take the assets and put it into an annuity, they no longer get paid on that money anymore. So it makes more sense for them to never tell you about them and how they work to your benefit.
Are you saying that Wall Street wants you fully invested all the time?
Yeah, well, that's exactly what I'm saying.
Okay, just curious.
Well, and that actually brings us back around to the big word that we talked about, I think, on the first podcast, which is fiduciary, right? We spoke a little bit about that. You guys are fiduciaries because basically what that means for the people that are joining us for the first time is that these guys hold themselves to a higher standard. They only act in the best interest of their client. It's not about their own pockets, their own checking account. It is about what is best for you, and they're held to that standard as a fiduciary. So I just wanted to clarify that. Guys, this has been a great podcast, a lot of great information. Is there anything else we need to say before we close this out today?
I just want to wrap up with what you just talked about there. We embrace different investment vehicles based on what our clients' needs are. We have just about everything available under the sun. So we're looking at what solves the problem for these particular clients. And I think when you embrace the vehicle that's right for that particular situation, it doesn't make any difference if you're looking for gains or growth or taxes. We have the right vehicle to approach that.
Yeah, that's why we call it a tool bag. And we go to our tool bag to find the right product that fits with what the need is. And we're not married to any one company or any one direction to go into in order to provide solutions to our clients.
Not every tool is a hammer.
That's right. All right, guys, thank you so much for your time today. This has been a great, very highly informational podcast. If people are looking to have this conversation and say, you know what, a couple of those stories that you told that really resonated with me, or there is a history of some health issues in my family that, I do have some concerns about, and I need to talk to somebody about it. What's the best way to get a hold of you?
Best way to get a hold of us, Eric, is to you can either go to our website at wellroundedretirement.com, and it has contact information there, or you can call us directly at 281-665-3081. It's 281-665-3081, or email either Jim or myself, John, at CRISfinancial.com, CRIS financial.com. And we'd be happy to discuss your particular situation and come up with some solutions that hopefully fit with the need.
Absolutely. Please do reach out to these guys. They will have an honest and frank conversation with you to dispel those myths, because not all long-term care insurance is bad. Not all annuities are bad unless they're being sold by a guy in a trench coat and has watches on one hand and maybe, a pocket full of annuities another. Just avoid that guy altogether. But
Hey, Eric, we want to let people know that if they're interested, we do have a full webinar that we did on this particular topic that we could send to them free of charge. So if anybody's interested, we'd be glad to send this to you. It goes into a little bit more detail.
Perfect. Thanks, guys, so much. That is a huge help, and I know that hopefully people are reaching out at least to get that. Now, do they just go to the website, or do you want them to email you for that?
Either way, they can go to the website, they can email us. We will respond.
Fantastic. Thank you guys for your time.
Thank you.
Thank you, Eric.
You bet. And the last thank you always goes to you, the listening audience. Thank you for tuning in and listening to the Well-Rounded Retirement Podcast with Jim Donewald and John Glowhouse. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when Jim and John come out with a new podcast, it'll show up directly on your listening device. This makes it much easier to share these podcasts with your friends and family. Again, thank you so much for listening today. For everyone at CRIS Financial, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to the Well-Rounded Retirement Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of CRIS Financial. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service providers with any questions you may have regarding your investment planning.